This is Ryan. He is staring at his screen. His jaw is slightly open. His hand is frozen on the mouse. He is anxious, nervous. Then his hand moves. He clicks, sells. Sold. He just funded their entry. $178 million, liquidated in 24 hours. And Ryan, and millions like him, sent every single dollar directly into institutional hands. Not because he panicked, because he never understood what he was looking at. This is not a crash story. This is a mechanic story. And by the time this video ends, you will never look at a wick the same way again. Okay, let's rewind 18 hours. Ryan is 27. He bought Bitcoin at $88,000 using a 3x leveraged position. He understood the thesis: fixed supply, institutional adoption, digital gold. He wasn't wrong about any of that. He was wrong about one thing. He thought understanding the thesis was the same as having a plan. When the wick hit 65,000 this morning, Ryan felt it in his chest before he understood it in his head. He checked his portfolio 14 times. He wasn't looking for information. He was looking for permission to feel okay. He never found it, so he sold. Pause 1 second. Matt is at his desk, notebook open, pen in hand. Same chart, same wick, same moment. Matt is 38, 6 years in this market. 2 weeks ago, when Bitcoin lost the 50-week moving average, he closed his leverage position, took the loss, documented it, moved on. When Matt saw the wick this morning, he didn't check his portfolio. He opened his notebook and wrote 3 words. Stop hunt, confirm. He's not anxious, he's waiting. Tom is 44. He didn't see the wick this morning. He found out about it on Saturday. His recurring buy executed Monday at $65,000, the same fixed amount it executes every Monday, regardless of what the chart looks like. He didn't authorize it manually. He said it years ago and stopped thinking about it. 3 people, same chart, same candle, 3 completely different outcomes. Here's what actually happened and why Ryan never had a chance. Before we go further, where are you watching from? Drop a comment with your city, the time, and 1 word. Trap or crash? I want to see the global split in real time. Are you seeing the manipulation or are you feeling the bleed? And if you already have a feeling this 65 KLA level is part of a much bigger game, hit that like button right now. Because what I'm about to show you is a shift in institutional behavior that we haven't seen at this scale. Subscribe, and let's dive into the data. According to CoinGlass heatmap data and order flow analysis from Bybit and Binance, the densest liquidity clusters in the entire market were sitting in 2 zones: $65,000 to $66,000, concentrated leveraged retail longs, traders who entered on the strong support narrative, the exact narrative every analyst on crypto Twitter was promoting. $67,000 to $72,000, short positions stacked by traders expecting further downside. Both pools were visible, both were known, and the entities with enough capital to move price deliberately could see exactly where maximum pain was located. And what happened next? Price swept aggressively through the $65,000 to $66,000 zone. $178 million in long liquidations in 24 hours. Isolated liquidations of $2 million or more appeared precisely on top of the retail stop-loss clusters. The shorts barely touched. And Bitcoin never closed below 64,800 on a daily basis. The wick went exactly to the pool of liquidity. And reversed. Classic bear trap architecture. Hunt the weak, absorb the supply, prepare the squeeze. Orion. Bitcoin broke 65,000 support. It's going lower. He sold. Matt. Stop hunt. Wick below support. No daily close below. Watching for reversal confirmation. Tom. He was at dinner. His Monday buy executed at 65,000. He found out about the wick on Saturday. Ryan just funded the institutional entry, precisely, involuntarily, and on schedule. Here's what CNBC showed you. BlackRock IBIT. $84.2 million in outflows on February 18th. Fidelity FBTC, $49 million out. Total spot ETF outflows, negative $133 million on the day, negative $237 million on the week. CNBC's headline, Institutional Investors are leaving Bitcoin. Fear and greed drops to 12. Ryan panics, sells. Here's what CNBC didn't show you. Switch to corporate treasury filings. Strategy purchased 2,486 Bitcoin for $168 million last week. Average price, $67,700. Total holdings, 717,131 Bitcoin. Not selling a single coin. Metaplanet holds 35,000 Bitcoin. Raised capital in January specifically to buy more, targeting 210,000 Bitcoin by 2027. New and large whale addresses, wallets holding between 1,000 and 10,000 Bitcoin, accumulated 170,000 Bitcoin in 2026 so far. Same week. ETF funds selling at $65,000 to $67,000. Corporate treasuries buying at $65,000 to $67,000. Different categories of money, completely opposite time horizons. Michael Saylor last week, while IBIT was bleeding, we buy Bitcoin. 2 words, $168 million. Ryan, C's ETF outflows? Institutions are leaving? He's right about the data, wrong about what it means. Tom, C's corporate treasury activity. The people with the longest horizons are loading up. Same data, opposite conclusion. The liquidity hunt didn't happen in a vacuum. It was enabled, maybe designed, to benefit from a very specific macro environment. The Bank of Japan has been normalizing rates, hiking from 0% toward 0.75%, with more hikes expected in 2026. This is unwinding the yen carry trade, the mechanism by which cheap Japanese capital was borrowed and invested in risk assets globally, including Bitcoin. As that capital repatriates, as the yen strengthens and the carry trade becomes less profitable, risk assets get sold, not because they're broken, because the financing vehicle that funded their purchase is closing. Estimated active yen carry position still in the market, $500 billion. That's the pressure still to come. Add US 10-year yields, rising plus hawkish Fed language, dollar strength, and Bitcoin fell alongside tech stocks, not because of a fundamental problem, but because of how Bitcoin is now embedded in the traditional financial system through ETF securitization. The institutions that wanted to accumulate more Bitcoin at a discount needed retail to sell. The macro environment provided exactly that catalyst. The move from $70,000 to $65,000 was the price institutions needed to enter more cheaply. The macro forced the flush. Smart money said, thank you. There's a specific on-chain metric, SOPR, that tells you with precision when this accumulation phase ends and the squeeze begins. I'll get back to that. If retail was truly dumping en masse, exchange inflows would spike. They haven't. Exchange supply is structurally low and not rising despite the price drop. Long-term holder UTXOs, coins held for 1 year or more, unchanged. The hands that matter are not selling. Realized price, approximately $54,900 to $56,000. That's the structural floor where the cost basis of the majority of holders sits. Bitcoin would need to reach that level to push most holders underwater and trigger true capitulation. 2 moves that tell the real story: 909 Bitcoin from a 13-year-old wallet, 2,000 Bitcoin from a 7-year-old wallet, both absorbed without price impact. That's the signature of deep institutional buying underneath. Realized losses on-chain, $5.4 billion per day at the peak of the recent sell-off. Historically, that level marks late-stage capitulation, not the beginning of a crash, the end of one. Ryan, this is terrifying. He doesn't know when it ends. Matt, it's a setup to analyze. Tom, it's context that explains why the fundamentals remain intact even as price compresses. The 5 signals when the squeeze begins. 11, 0, 0. Here are the specific signals that will tell you the bear trap is executing as designed, that the squeeze phase has begun. Signal 1, price structure. Bitcoin holds above 64,800 on daily closes for 5 or more consecutive days. Trap confirmed. Bitcoin breaks above 70,000 with volume. Short squeeze initiating. Bitcoin breaks above 75,000. Forced short covering begins. The squeeze becomes self-reinforcing. Signal 2, ETF flow reversal. Watch for IBIT and FBTC returning to net positive inflows for 3 consecutive days. A single day of positive $200 million or more after this outflow period is the institutional reentry signal. Signal 3, corporate treasury announcements. Any new public company announcing a Bitcoin treasury strategy in the next 30 days. Strategy announcing another purchase above $100 million. Saylor signaling continued conviction at current prices. One announcement can change the narrative faster than any chart level. Signal 4, on-chain accumulation. Exchange outflows accelerating. Bitcoin leaving exchanges means fewer coins available to sell. Whale address, count for wallets holding 1,000 to 10,000 Bitcoin increasing. Realized price holding above 54,900. No mass underwater selling. This is exactly what I told you to watch at the start of the video. The on-chain accumulation pattern. Now you know what it looks like when it confirms. Signal 5, the macro trigger. Any Fed pivot language, rate cut signals or quantitative tightening pause, equals liquidity returning to risk assets. USD JPY breaking below 150. Yen carry unwind potential peak. Bank of Japan pausing rate hikes. Relief for carry trade funded risk assets globally. Tom monitors these signals not to time the market, to confirm the thesis is intact. Matt uses them as entry and exit triggers. Ryan ignores them and reacts to price alone. You've been watching this for 14 minutes now. You know about the liquidity hunt. You know about the ETF divergence. You know about the yen carry trade. You know what the on-chain data says. So let me ask you the same question I asked at the beginning, but now you have the data to answer it honestly. If Bitcoin drops to $50,000, what's your immediate emotional reaction? If the answer changed after this video, that's important information. It means your behavior was being driven by incomplete data, not by your actual risk tolerance. If you are Ryan. The first step is not buying more Bitcoin. The first step is removing the leverage, not because Bitcoin is going to zero, it isn't, but because leverage in a bear trap environment is designed to extract your capital before the squeeze happens. The institutions that set this trap are patient. Ryan's margin call is not. Second, decide your actual time horizon. If you cannot hold through $50,000 or $45,000 without psychological damage, your position size is larger than your emotional infrastructure can support. That's not a market problem. That's a position sizing problem. Third, write down the price at which you will no longer be able to sleep. That's your real risk tolerance. Build your position around that number, not around your conviction in the thesis. If you are Matt, the technical setup right now is a textbook bear trap with potential squeeze architecture. 64,800 is the actual daily close floor. If Bitcoin does not close multiple consecutive days below this level, the trap thesis holds. 58,000, the 200 EMA, is the generational long setup for patient traders, but it will feel apocalyptic when it happens. 72 to 75,000 is where the shorts are stacked. A breakout above triggers forced covering. The on-chain data says smart money is absorbing. The institutional data says corporate buyers are loading. The technical data says the wick to 64,800 was a precision stop hunt. 3 data sources align. High probability setup, but respect the macro until it changes. If you are Tom already knows what to do. He's known since he built his thesis. The question isn't what to do, it's whether he has the emotional infrastructure to actually execute it. Dollar cost average still running? Good, don't change it. Have extra capital saved for a dip? This is the dip you saved it for. Feeling the urge to check the price every hour? That's the Ryan inside you asking to be heard. Acknowledge it, then close the app. Reading headlines about crypto winter? Remember, Strategy just bought $168 million this week. Metaplanet is targeting 210,000 Bitcoin. The people with the longest time horizons are not acting like it's winter. For Tom, $65,000 is not a problem. It's a gift. Bitcoin at $65,000 is not a crash. It's an engineered liquidity event. Mechanics now exposed, data now visible. The institutions that set the trap are sitting on cheaper Bitcoin than they held last week. Ryan funded that entry. Matt is watching the confirmation signals. Tom is at dinner. Earlier I mentioned SOPR, spent output profit ratio, the on-chain metric that tells you with precision when the accumulation phase ends and the distribution phase begins. When SOPR signals flip, the squeeze isn't a hypothesis anymore, it's in the data. That's exactly what I'm covering in the next video, the specific SOPR threshold, the historical pattern, and how Tom uses it to time his extra capital deployment without ever needing to predict price direction. Drop a comment with one word, Ryan, Matt, or Tom, and the one signal from today's video you're going to track starting now. If this video changed how you read that wick, not the price, the mechanics behind the price, that like button is how you tell the algorithm this kind of analysis is worth amplifying. See you in the next one.